it's good to know where you've been. And this is a chart of the XAU Gold Mining Index, but measured differently. It's measured in terms of ounces and gold grams, rather than looking at it in terms of US dollars. It goes back to the mid-1980s, and you can see from 1997 to the present, it's not a very pretty picture, but I think this is about to change. You know, we all know that the mining stocks have been underperforming the price of gold itself, but we actually have to look and explain why that's been occurring. And there are a number of factors, and the first is basically worsening sentiment, and it goes back to 1997 with the collapse of VRIC. You know, it was the first shock to the industry, and that started making people nervous about, you know, the mining stocks in general. After the collapse of VRIC, we had some disastrous hedging programs where the mining companies had sold forward production. A number of mining companies ended up going bankrupt because they did a silly thing. They fixed their revenue, but they left open their expenses. And in an inflationary environment, which is what we had, margins got squeezed. They couldn't make any money. They got margin squeeze, and basically a lot of them ended up going out of business, and it really hurt the whole mining sector. The second thing about the second factor affecting sentiment was the launch of the bullion ETFs. What happened here is that because sentiment had been falling anyway with regard to the mining shares, and we saw, you know, some classic failures like Sunset Qualia, a big Australian mining company that went bankrupt because of hedging. You know, people said, well, why do I need to buy a mining company? Why don't I just buy the bullion ETF itself and have exposure to the mining sector? So, you know, the demand from the bullion ETFs, I think, has taken a lot of money away that would otherwise have gone into the mining stocks themselves. But the third and most important factor as to why we had that red arrow, the decline of the past 15 years or so, was the input costs were rising faster than the gold price, squeezing margins. I'd like to take a couple minutes to explain exactly that. I'm going to do this with a chart of crude oil prices. And this is crude oil measured in terms of gold grams. And you can see, going back to the 1980s, a historical pattern basically between 1 and 2.2 grams of gold per barrel of crude oil, except for back in 1990, during the period of the Gulf War, we went outside of the normal historical band. But look what happened in the first part, you know, basically all decade long. You had oil prices much higher than any historical average. Now this is just oil prices, but this is basically reflective of every kind of input cost that the mining companies were incurring over this 10-year period of time. Steel, chemicals, labor, everything was going up faster than the price of gold, but now we're back into the comfort zone again, where mining companies could start making a decent profit. And in fact, we've seen this because of the rising cash flow. Some of the majors are generating some very good cash flow numbers. And you've seen some of the majors also increasing their dividends as a reflection that they are generating good profits. So going back to that red chart, instead of the red arrow on that long-term chart of the XAU index, let's look at this not in an emotional way, but actually in a logical way. And this is the same chart, but I put it on here what I call a selling area and a buying area. And you can see down there on the right-hand side that basically the mining stocks are at historically low levels. We got the selling climax at the after the Lehman Brothers collapse. You know, I was saying how sentiment was changing over that period of time and that the mining stocks were in a bear market. Well, the bear market that started with the collapse of VRIC ended with the collapse of Lehman Brothers, when the mining stocks were being thrown out on pennies in the dollar. The interesting thing is we're back at those same levels of valuation, despite the fact that we've had 3-4 years now of improving cash flow in the mining companies themselves. So investors are looking at this from an emotional point of view rather than a logical point of view. So, you know, it's been a tough 10, 12 years, but now what you have to do is take yourself out of the mind frame that the past is the past and look forward. And if you're going to be looking forward, I think you're going to see some very good numbers coming in terms of price appreciation in the mining stocks as this sector is once again discovered. Remember, every bull market has 3 phases. We're at stage 1 of the mining share bull market. During stage 1, you get a lot of apathy, neglect, a lot of worry about what could happen to your stocks. And people are, again, affected by the emotion rather than the logic. When you get the XAU index above 230, about 230 or so, when you get the HUI above, let's say, 630 or so, you begin stage 2 of the bull market in mining stocks. And I think there's a very good possibility you're going to see the XAU and the HUI above both of those key levels, not this year, but I think perhaps even in the first quarter, because I'm very, very bullish on the price of gold and silver, which is what I'm going to turn to right now. I can show you 2 quotes. The first one is gold still represents the ultimate form of payment in the world. And the second one, gold, unlike all other commodities, is a currency, and the major thrust in the demand for gold is not for jewelry. It's not for anything other than an escape from what is perceived to be the fiat money system. It's not perceived to be, because it really is. Paper money that seems to be deteriorating, and it's not seems to be, it is deteriorating, as I'll show you in a minute. Now, you may have recognized these quotes. Both of them are by Alan Greenspan. The first one was in 1999 when he was still chairman of the Federal Reserve, and that was the testimony before Congress, and then the second one was last year. Now, basically what he's saying is that gold is money. And that's what I want to use this chart to sort of illustrate that point. This is, again, crude oil prices, but it's going back much further, back to 1950. And this is a base 100 analysis. In other words, I'm indexing the price of crude oil in these 5 different currencies that I'm going to show you back to January of 1950, and makes it easy to compare what's happened to the price of crude oil in terms of these 5 different currencies. So this is the price of crude oil in terms of the British pound. We all know that the price of crude oil has been rising. This is the price of crude oil against the US dollar. Now, as bad as it's been for the US dollar, the British pound is even worse. It's lost more money, it's lost more purchasing power because of inflation than the US dollar. We're measuring these against the same standard of barrel of crude oil. Now, the third currency is the Canadian dollar, which, as you might expect, is pretty closely tracked what's happened to the US dollar. Now, the fourth currency, and watch this carefully, this is the price of crude oil in terms of gold. If you calculate prices of goods and services in terms of a national currency, you get a different result than if you calculate the price of goods and services in terms of real money, in terms of gold. Not only in terms of gold, but watch the bottom of the chart again. Silver too. Silver has maintained its purchasing power over this period of time. And to give you a real-life example, I remember growing up in the 50s in the United States, and my parents would drive the family car to the local gas station, use $2 silver and fill up the family car. Today, $2 won't even give you a gallon of gasoline, but if you take the content in $2 silver, you can still fill up the family car. That's basically what this chart is saying. An ounce of gold purchases the same amount of crude oil it did 50 or 60 years ago, explaining why gold is money. It's money because it's useful in economic calculation. It's also money because it's the only thing we humans produce for accumulation. We don't produce soybeans for accumulation. We don't produce crude oil for accumulation. No commodities are produced for accumulation with the exception of gold. Everything that's mined still exists in its above ground stock. And because value comes from an item's utility, the value of the utility that comes from gold is the fact that it's useful in economic calculation, because this above ground stock of gold grows about the same rate as world population growth and new wealth creation, with the consequence that over long periods of time, gold has a very consistent purchasing power, which is why we humans chose this money 5,000 years ago in the first place. Now, given the fact that gold is money, where does it fit in your portfolio? You've got 2 components to every portfolio. You've got your investments, which are your wealth-producing assets, and you've got your liquidity, which is your wealth-preserving assets. In other words, after you sell an investment, you've got the proceeds, and you have to decide, where and how am I going to keep those proceeds? Investments are risk-reward, and liquidity is focusing more on safety. In other words, after you sold an investment, you want to preserve that purchasing power until you're ready to make another investment or purchase some consumer good. So in the investment part of your portfolio, you've got stocks, including, of course, gold stocks, bonds, and all other assets. You know, these are things that generate cash flow.